Hey everyone, and welcome back to the channel. Today, we're diving deep into the fascinating world of financial market infrastructure, specifically looking at two titans, CME Group, ticker CME, and Intercontinental Exchange, or IC. These companies are the backbone of global finance, but they operate with very different strategies. So, if you're an investor looking for income, growth, or just curious about how these giants make money, stick around, because we're breaking it all down in an easy-to-understand way. Visual aid, split screen, left, CME Group logo, derivatives powerhouse, right, Intercontinental Exchange logo, diversified FinTech giant. Section 1. What they do, two different playbooks first, let's understand their core businesses. Think of financial markets like a giant playground. CME Group is like the company that owns the busiest swings, slides, and monkey bars, and charges a small fee every time someone uses them. They're the premier global marketplace for financial derivatives. On-screen text. CME, futures and options, the market utility. They essentially facilitate and clear, meaning, guarantee, trades for things like interest rates, stock indexes like the S&P 500, oil, gold, and even crypto futures. They own the trading platform, Globex, and the clearinghouse, capturing fees at every step. This makes them capital light and incredibly efficient. A huge plus? When markets get volatile, think geopolitical events or big interest rate changes, trading volumes surge because institutions need to manage risk. CME benefits directly from that chaos, almost like a built-in hedge against economic downturns. Visual aid, animated infographics showing different asset classes, money bags, oil barrel, gold bar, flowing into a central, CME clearing, hub with dollar signs coming out. Now, Intercontinental Exchange, or ICE, started similarly, primarily in energy trading. But they've taken a much different path. On-screen text. ICE, diversified ecosystem, exchanges, data, mortgage tech. ICE has strategically diversified, becoming a broad financial infrastructure and software conglomerate. They still run important exchanges, like for Brent crude oil, but they've significantly expanded into two other key areas, fixed income and data services, think subscription-based financial data, and mortgage technology. This mortgage segment is fascinating because it aims to digitize the entire U.S. residential mortgage process, shifting from one-off transaction fees to a more stable, recurring software as a service, or SaaS model. This diversification gives ICE a steadier revenue stream, but it also ties them to the housing market's ups and downs, and requires a lot of investment. Visual aid, ICE logo with three spokes radiating out, exchanges, data subscriptions, mortgage software, with respective icons. Section 2. How they've grown. Organic versus acquisitive. Let's look at their recent financial performance over the past 5 years, from 2021 to 2025. CME Group has shown remarkably consistent, profitable growth. Their revenue grew at about 8.6% annually, and their net income, that's their pure profit, grew even faster, at over 11% per year. On-screen text. CME, steady organic growth, strong profits. This shows their incredible operational leverage. More trading volume means more profit with minimal extra cost. This strong performance was largely driven by a period of higher interest rates and inflation, which spurred record trading in interest rate and commodity derivatives. Visual aid. Simple bar chart comparing CME's net revenue and net income growth over 5 years, showing steady upward trend. Call out. Net income CAGR, 11.33%. ICE, on the other hand, had a more expansive, but also more volatile, growth trajectory. Their revenue also grew about 8.6% annually, but their net income tells a different story. On-screen text. IC, M&A-driven growth, volatile net income. In 2022, their net income dropped sharply by over 64%. This was mainly due to non-cash write-downs from past acquisitions, particularly an investment in a crypto company called Bakkt. As these write-downs subsided, their profit rebounded, but over the 5 years, their net income actually declined annually, highlighting the integration risks of their aggressive acquisition strategy. Visual aid, bar chart comparing ICE's net revenue and net income growth, showing a significant dip in net income in 2022, then recovery. Call out. Net income CAGR, minus 4.93%. Section 3. Efficiency and balance sheet. Lean machine versus growth investment. Now, let's talk about profitability and debt. CME Group is a superstar here. They boast some of the highest operating efficiencies in the corporate world, with an operating margin of over 65% and a net income margin of over 63%. On-screen text. CME, industry-leading margins, 63.2% net income margin. This is like running a toll booth with almost no overhead. Every extra car adds directly to profit. They also have a very conservative balance sheet with minimal debt, which leads to excellent returns for shareholders. Visual aid. Comparison table. CME versus ICE, showing operating margin, net income margin, and total debt. Highlights CME's high margins and low debt. ICE has good margins too, with an operating margin around 50%, but it's diluted by their mortgage technology segment. While their exchanges are highly profitable, the mortgage tech division, especially due to amortization charges from acquisitions, operates at much lower GAAP margins. On-screen text. ICE, margins diluted by mortgage tech, high debt load. Furthermore, ICE has taken on a significant amount of debt, around $19 billion, to fund its acquisitions. This debt impacts its overall profitability and returns compared to CME. Section 4. What they own. Deep moats. Different dominions. Both companies have strong moats, competitive advantages that protect their market share. CME Group is the undisputed global leader in exchange-traded interest rate and equity index derivatives. On-screen text. CME, derivatives dominance, interest rates, S&P 500, WTI gold. They offer huge daily margin savings to institutions that clear diverse asset classes with them, making it incredibly difficult for competitors to lure away their clients. Think of it, if you can save billions by trading all your futures contracts in one place, why go anywhere else? They also have strong positions in energy, agriculture, metals, and even a rapidly growing crypto derivatives market. Visual aid. Icons representing CME's key derivative products. Treasury bond, S&P 500 chart, oil barrel, gold bar, Bitcoin symbol. ICE dominates in different, but equally crucial, areas. They're the global market leader in energy trading, particularly for Brent crude oil and European natural gas. On-screen text. ICE, energy, fixed income data, mortgage tech leadership. They also command the fixed income data space, with their subscription services generating high-margin recurring revenues. And in mortgage technology, they hold a leading market share in processing mortgage originations and servicing. So while CME owns the derivatives superhighway, ICE owns the energy superhighway and significant parts of the data and mortgage infrastructure. Visual aid. Icons for ICE's key areas. Oil rig, server rack for data, house for mortgage tech. Section 5. Returning money to you. Income versus reinvestment. How do these companies reward shareholders? CME Group is highly shareholder-friendly, using a dual-component dividend policy, a growing quarterly dividend combined with a year-end variable, or special, dividend based on their cash generation. On-screen text. CME, high, flexible dividend for 0.15% yield, income investor favorite. This provides a superior yield, often around 4% or more, making it very attractive for income-focused investors. Just a note, a recent administrative change means the 2025 variable dividend will be paid in early 2026, which temporarily impacts the calendar 2025 payout, but doesn't reflect any change in their cash flow or commitment. Visual aid. Bar chart comparing CME and ICE dividend yields. ICE uses a more traditional, conservative dividend approach. They offer a lower yield, typically around 1.3%, because they prioritize allocating cash flow towards paying down their substantial $19 billion debt load and funding continuous technological development in their mortgage and data segments. On-screen text. ICE, conservative dividend, 1.3% yield, reinvestment focus. Section 6. The road ahead and risks. What's next for these companies, and what should investors watch out for? CME Group is innovating, especially in the crypto space, having launched 24/7 crypto futures and options trading. This means continuous fee generation for digital asset managers. On-screen text. CME opportunities. 24/7 crypto trading, product innovation. However, their performance is sensitive to market volatility. A prolonged period of calm or low interest rates could reduce hedging volumes. Also, there's an ongoing corporate governance dispute about legacy share structures that they are working to resolve. On-screen text. CME risks. Low volatility, governance disputes. ICE is focused on modernizing financial workflows, like integrating stable coins as collateral. Their high-margin fixed income data services and investments in decentralized platforms offer strong growth potential. On-screen text. ICE opportunities, mortgage digitization, digital assets, data services. The primary risks for ICE are its sensitivity to the cyclical U.S. housing market and its elevated debt load, which can restrict financial flexibility, especially in high-interest rate environments. On-screen text. ICE risks, housing market cyclicality, high debt load. Section 7. Latest developments, Q1 2026. Just to give you a quick update, in Q1 2026, CME Group reported record revenue and a big jump in net income. However, the stock actually fell slightly because expectations were even higher. This shows the premium valuation on CME. They also proposed charter amendments to resolve their governance issues, which is a positive step. Visual aid, newspaper headline graphic. CME Q1 record revenue, stock dips on miss. ICE has seen some stock price volatility recently, hitting a 52-week low. This reflects ongoing headwinds in the mortgage market and high integration costs. But the good news is their recurring exchange data revenues and environmental derivatives trading remain very resilient, providing a solid foundation. Visual aid, newspaper headline graphic. ICE stock hits 52-week low. Core business resilient. Conclusion, investment takeaways. So, who should you invest in? It really depends on your investment goals. On-screen text. CME, for value, income, and defensive qualities. For income-oriented and value-focused portfolios, CME Group is a highly attractive core holding. It offers high-yield cash generation, a conservative balance sheet, and highly resilient cash flows, particularly during market stress. It's a defensive play with consistent returns. On-screen text. ICE, for growth, SaaS, and diversification. For growth-focused portfolios, Intercontinental Exchange offers a compelling long-term expansion play. While it has higher debt and more exposure to market cycles, its dominant energy benchmarks, recurring data revenues, and the potential from its mortgage technology integrations position it for significant long-term capital appreciation as markets recover and tech integrations scale. Neither is a bad investment, but they serve different purposes. CME is your steady, high-yielding utility, while ICE is your diversified growth engine navigating a more complex path. Visual aid, final split screen comparing. CME pros/cons versus ICE pros/cons. Based on the text's investment strategy matrix. I hope this breakdown helps you understand these financial giants better. If you found this video helpful, please hit that like button, subscribe for more in-depth analyses, and let me know in the comments below which company you're more bullish on. Thanks for watching, and I'll see you in the next video.